Hello, everybody, and welcome to the High Return Real Estate Show. My name is Jeff Schechter, aka Shecky, and I am with my amazing business partner, Mr. Jack Gibson. Hello, Jack.
Hey, Shecky, great to be here as always.
Yeah, great to have you. We've got a very unusual podcast today, and admittedly, what people might think is probably the most boring topic on earth. We're going to be talking about property insurance. But we've got just an absolutely amazing guest who I'm going to introduce in a minute. And we are going to make this topic super interesting and super informative. And everybody that listens all the way through is going to have so much better handle on understanding the nature of this really important facet of real estate investing. So really excited about this show. Stay tuned and we'll be right with you. Welcome to the High Return Real Estate Show, the podcast for heavy hitters. Two men, one mission. It's time to build your empire. So welcome everybody. Today we've got a very, very interesting show for you. And we've got a very, very special guest that I want to introduce. His name is Mr. Man Phung. Hello, Man.
Hey, Jackie. Thanks for having me here.
Yeah, we're so excited to have you, brother. Really appreciate you. And we got a lot of really great stuff to cover today. So Jack and I are just going to kind of pepper you with questions. But there's some really just important things to dive into, just concepts about, replacement coverage versus actual price, covering vacant properties and why you even want to have insurance on the first place, how and when to file claims. And, what the heck is a broker anyway? And then we're going to also talk about some actual claim experiences. So we are thrilled to have you and the expertise that you bring to the show. And tell the listeners a little bit more about you. I mean, I know you are the owner of the Brightway agency here in Indianapolis, but tell us a little bit about you and how you came to own that and some of your goals and visions for your business.
Absolutely. I'm in my 30s, a very young insurance owner, agent, if you will. I've been, prior to me opening this agency, I've been in the car business as a salesperson, to finance managers, to being a general manager of a high-end dealership here in Fishers, Indiana. And so I've been doing it for 10 years. And what makes me, how did I, acquire Brightway is because one day I just got tired of working for an owner who wouldn't listen to me on how to grow business and how to, make more money. I mean, essentially at the end of the day, that's what we're all here for, is to make a lot of money. And so I got really fed up with it. And I got approached by one of the, an Allstate agency to say, hey, why don't you get into insurance? We like your background. Well, I almost joined, but there was a couple of things that I didn't like about it. I just won't go into much detail. And so keep in mind that I had a few months already vested time into this operation, had my license, and things just kind of fell apart. And one day I just said, why don't I just go into independent and be an independent insurance agent? And so I jump online, Google independent insurance agents or agency. And sure enough, the word Brightway came up. And so a little bit about Brightway. We are it's a national franchise, the number 7th largest independent agency in the United States, with close to $500 million in revenue every year. We are the number 1 on Forbes magazine franchise of the year. And also there's a few top 3 franchise online. And so talking to them a little bit and understanding, hey, I can be a franchise owner representing more than, 20 to 40 different insurance carriers, as opposed to just having, represent 1 or 7, or being a captive agent like State Farm, Allstate, or Farmers, some of the big names that you guys probably know, or just being an independent agent that have just, 6 or 7, when I can actually have 20 to 40 different carriers. And so that's how I kind of got convinced into getting into insurance with Brightway agency here. And we are the first one here in Indiana. A little bit about my agency as well is I have over 130 licensed customer service rep at all times to handle any insurance servicing. So after, if you do purchase an insurance with us, we'll have over 130 licensed agents to take care of all your needs.
That's awesome. It's really great. And I got to tell you on a personal note, I mean, I certainly get not wanting to stay in the car business forever, because for me, as an aside, the car business was something that I used to make money to fund some of my other, entrepreneurial habits and ventures. So, the nature of that business is just crazy long hours and
absolutely
very, very high stress.
And the other thing that I do have in common with your listeners, or who soon to be your clients, is, I own over 10 personal properties that I invest myself, and rent it out here in Indianapolis. So I understand, the market. I understand the rentals. I understand, what everybody's going through, or who's about to invest their first piece of property, and they can be very overwhelming with that process. Is this really a true turnkey operation? Who am I dealing with? So I understand that whole feelings, and I can always help them walk through. Just to make sure that they understand that hey, you're making the right decision. Oh, hey, you might want to do this. So personally, I've owned 10 properties in the last 4 years here in Indianapolis, Indiana.
Yeah, and I think that's great, because I think it makes you, aside from the fact that you do a great job for us and for our investors, you are certainly uniquely qualified to answer all these questions. One of the reasons that Jack and I wanted to have you on the show was because you are also a fellow investor and you completely get the nuances of what we're doing. So that said, I kind of want to jump right into it. And I know, even myself, and Jack and I as well, just operating a turnkey company, even though we're not insurance agents, we often get this question from our investors is, what is the heck is the difference between insuring for replacement coverage versus insuring for what the actual price paid is? And I'm asking, and I think the reason that they ask is because typically, being a good turnkey company, a lot of our properties are typically sold below market value. So, the investor doesn't necessarily want to spend money unnecessarily. So could you address that for us, Man?
Absolutely. So the two questions that I personally get a lot as well, is, okay, so replacement cost and insurance actual price. So most of the homes that are considered investing, to turn around and get a good deal and have renters in there to build cash flow and to build equity, is okay. So replacement coverage is very, very it's simple. If your home were to burn to the ground, that is what they call replacement coverage. So how much would it cost to build this home? Let's just say you have a 1955 home. Well, the building material back in 1955 are probably not existing anymore. They might use siding woods, or just some of the materials on the windows are no longer there. And so now here in 2017, when we're building a new home, something similar to that square footage, similar bathroom, if you have a basement, roof, what is it going to cost to build, let's just say it's 1,000 square foot home to a brand new home? Well, that's where the replacement coverage said. So in this instance, let's just say your investor buy a home for $60,000 and the replacement cost is $200,000. Well, when you get an insurance and you do a replacement coverage, they're going to say that if the house burned down, this is what it will cost to rebuild that home. And so by having a replacement coverage, we'll cover up to that amount cost to rebuild. Now, when you're insuring for the actual price of the paid of your home, is very simple. So if the house is $200,000 cost to rebuild, and you're just saying, hey, I'm only going to insure for $60,000, well, they're only going to give you up to $60,000 to rebuild that home, leaving you, with the other $140,000 to come out of pocket. Now, when it comes down to price point between replacement coverage and actual price, I'll be very honest with you guys, it's not much more, but it just kind of gives you that peace of mind when you're investing is $60,000, $70,000 on your home. you want to make sure that if something does, happen, bad things happen, like a catastrophic loss, a storm, lightning hit your home, or just the unforeseen event happen, you want to make sure that your investment is properly protected while in the event of a huge loss.
Gotcha. Okay. So what would you say is the difference? Because you said the difference is pretty minimal. What is it, like 10% difference, 20%? I mean, there's a pretty big spread there that you gave between 60K and 200K.
We're not, I mean, we're and I'm just using the scenario. Your scenario will vary depending on the home. I mean, it's just a lot of variable, but let's just take one of my home that I actually own. I paid about $90,000 for it here in South Indy. And when I ran a coverage for myself, it was about, I think it was $600 just to insure up to $80,000 of what I paid. Well, the replacement cost on that was about $190. When I end up in adding a full replacement cost, it went up to less than $1,000 to actually have a full replacement cost on that home. So my home is a little unique. Your home that you're looking to buy, your listener looking to buy, might be different, might be a little bit less, might be more. It just, no two homes are alike. So when we actually sit down and we talk to your listeners, when we find out, what's the right coverage, we're going to go into a little bit more details about that actual home before the actual replacement costs come up. I've seen homes that actually only changes about $150 just because of the replacement costs. They didn't anticipate as much as they thought it would be. So again, to give an extra $50 a month or $40 a month to have a replacement cost really pays off in the event you do have a total loss. And the other thing that I always joke with my customers is, hey, if your house burned down, you just gain 100, 300, 400, 500% on your investment. But don't go burn your house down, but if it does happen, you're going to have, full replace on your home that's worth $200,000 if you paid $60,000, $70,000 for it. To me, that's a win-win.
Yeah, this is Jack. I got a question.
Yes, Jack.
So are you in favor of always having the replacement coverage protection on a policy, or are you kind of saying it's kind of based on the property? So for example, on the one where, let's say the insurance goes from $600 for the year, up to $1,000 or more on that policy, my thought for the investors, because that event is going to be so rare, that they would just want to have the, purchase price protection. So in that, rare event, boom, they get all their investment capital back, and then they can just go on and buy a different property. So I'm just trying to figure out, based on your, expertise, when are you recommending replacement coverage, and when does it maybe not make sense?
My question to it is, obviously the premium doubles. Let's just say it's $600-$700 for actual cash value, or for what you paid for, or actual cash value, as opposed to replacement. And if it doubles, to $1,600 and $1,800, then yeah, at that point, absolutely, it's going to get into your cash flow. It doesn't make any sense. That's usually when you're going to make that decision. But here's what I always ask my client is to imagine if your house is burned down today, or your rental. What would you want to do? Would you want to rebuild it to the $200,000 or whatever the replacement cost that would be, and continue to own that and invest that, or do you want to just take the $60,000-$70,000 and if you still want to stay in the area and take the gamble of paying the other $130,000 it costs to rebuild? What would you want to do? I am in all favor for replacement coverage, just for the fact that I want to protect my investment. And if something, if it burns down completely, and it doesn't even have to burn down completely, it could be a storm come through and rips the whole roof, $6,000, $8,000 just hypothetically cover. Having a replacement cost will replace the roof, where you have an actual price on the pay insurance. They would depreciate under the actual cash value. So you might not get the full $8,000 to replace a roof, or if there's something happened to the porch, or just for that nature. So the replacement coverage will replace actual costs. When you do an actual cash value type of insurance, it's subject to depreciation.
Interesting.
Yeah, gotcha. That's great. I mean, yeah, my thought would be kind of depends on the property, right? And then if I really just want to, purchase or have my purchase price covered so that I can just take that 60, get it back, and then just go buy a different property versus trying to rebuild it. So I think it does depend on, it'll be situational depending on how much does that premium go up for the full replacement coverage.
Right. So again, cool. it just all varies on your risk level. If you are the type of investor that just want to be sound investing and not have to worry, like myself, if something does happen, I want a replacement cost. If you have a higher risk level, saying, you know what, I'm okay with just taking what I paid in it, and just use that as an actual cash value type of policy, then that's more for you. But for most of my clients, from experience, have always wanted to do replacement costs just for the fact of being able to replace 100% of that home in the event of a total loss.
Do you go through and kind of explain this to the clients? Is the difference when they were to call you? I mean, educating them, is this part of your process?
Absolutely. There is no one size fit all. And what I found over the years, even before I got into the insurance, is the agents always speak to me like I'm a doctor, educated, understanding all these terms. A lot of time we get into this rut where we talk about it every day and we take things for granted that our consumers knows it all. So we do a need analysis, and we ask every single question. It takes about 20 minutes to get to understand what you're looking for. Okay, so your home, we understand what you pay for your home. This is what it's cost to replace. Well, does your home have a basement? Does it have a new roof? Does it have any other structure? If you, let's just say Indiana, there's pole barns. Who would have thought if you're in Washington, you know what pole barn is? Well, there's a lot of them out here, so we understand what's the cost of that pole barns. Well, same thing when the investors, we ask them, okay, what about, do you have any personal property in that home that you're going to be putting in that home? We want to know how much it is. And if you're not going to put anything, just a couple grand, we want to know that too, so we properly insure you. The other part that when we do replacement coverage, it isn't optional, is what we call rent. And this is very important, because if that house burned down and, while you're talking to your insurance adjuster, trying to figure out, the settlement and so forth, your renters is going to move out, or you're going to lose rent. Well, there is a separate endorsement that we add to the policy where you're going to have rent paid in the event you do lose rent for up to a certain amount of the replacement cost. So take the replacement cost, for instance, let's just say it's $200,000. Well, you're going to get roughly about $80,000, up to $80,000 for loss of rent and usage while your home is getting rebuilt. A lot of renters or investors don't understand that is available. So now not only your home is burned down, but you don't have any income from your investment. But by having that, will supplement in addition to while your home is getting rebuilt, so you're not in the negative in the cash flow, if you will, or you're sitting around in a year, if you're $50,000, $60,000, $70,000 investment, not making any money. By having that coverage addition into it will allow you to have that. Now, the other part also important when we ask your customer or your clients, I should say, with personal liability, which is very important, especially from the investor standpoint. If somebody's on that property and gets hurt, fall, break their leg, I mean, we're in the DNA of people suing each other just for anything. Your home policy or your rental policy will give you a personal liability, generally from anywhere from $300,000 to $500,000. To pay for any type of liability that goes against you, where you get sued or for whatever reason. So there's a lot of things that we ask your clients and our clients when we sit down with the policies. We want to make sure that, hey, it's a not one size fit all type of insurance. We need to figure out, do you really need this or do you not need it? We don't just sell insurance at our agency. We sell peace of mind. And I'm sure your listeners can appreciate that, because when they're investing in a property, especially if they're living out of state, They want to make sure that this property is properly protected in the event of something happen, and so that they're not any holding any liability if something does happen while they're investing in that home and renting it out.
Yeah, I got to jump in here. What's interesting to me is I'm kind of sitting here having an aha moment and going, insurance it's just kind of this mundane subject, but every single one of these listeners is an investor, including all of us. And it's a very different thing when you are insuring, or let me use a better word, protecting an asset that is throwing off a lot of cash for you. I mean, that's the whole point of real estate investing, or at least the buy and hold investing, the kind of stuff that we're doing. So when you start getting into some of these, additional features, Man, that allow people to recoup rental income and things like that, I just think that that's huge. And I think it's a really, really strong consideration for people that are doing turnkey investing, because, essentially, we're trying to get as close as we can to set it and forget it. Now, we know it's not a perfect world and probably never quite be that, but we want to get as close to that as we possibly can to create passive income. And when you get used to that passive income, when that sucker gets interrupted, it could be painful. It could be painful financially. So I love what you said about that stuff. My question is really more, I'm a little bit confused, is that the same thing as modified replacement? Because I keep hearing that term and I'm not necessarily sure what that means. Can you explain that?
Yeah, so absolutely. So modified replacement cost comes in when we have a special home, like a vintage home, where it's a early 1900 home, where it just costs way too much to rebuild that type of home. So when the term modified, and we here and there we'll see that. And so again, your home will vary. So once we actually plug in the address, we will know what type of coverage to talk about. But when that does happen, modifiers, they take something similar to that material to rebuild that home. So let's just take, let's go move back to 2017 or 2000, and an actual material, in 2000 will cost more to rebuild. Well, I want to build something similar to that design that I have now, but that material costs twice as much. Well, the insurance company will allow you to do a modified coverage replacement cost to where it's something similar. Just think of your deck, right? If you guys have a deck in your home and you use just regular wood, and I'm not sure if you guys know the material Trex, or Trex, I should say. Well, it's similar to that type of wood. It costs more, and so it's just kind of like, well, it looks just about the same, but it's a different material. Well, it's not. It just costs more to use that material. So if you have Trex on your deck, they might not put a Trex on your deck. They're probably just going to use wood just to make it look like that, because it's going to cost a little bit cheaper, but it's your deck is going to be rebuilt just like you had before. So does that make sense?
Yes, absolutely. And we do run into that because occasionally we have some older homes. So, it does happen. Another question that I get all the time from investors, because, a lot of times we are getting a property ready for an investor. And sometimes there's a week or two or three or whatever it is when we're finishing up a rehab and the investor's buying the property, but until we get finished, and again, it's a very short period of time, that property is vacant, right? And oftentimes the investor will tell me, well, I'll just wait till I have a renter in there, and then I'll get my insurance. Then I'm just gonna let it slide for 2-3 weeks, whatever it is, until we get the renter in there. So, my feeling is, maybe, knowing that you're just buying something and it's just about to be rehab, there's still things that can go wrong, obviously, acts of God, that sort of stuff that have nothing to do with renters. But I understand the investor's posture on that. And I'm curious to know what you think of, just covering a vacant property, and if so, if you're for it or against it, and if you're for it, what's involved in transitioning to something where there's actually renters, and how is that insurance different?
Okay, so the definition of vacant in the insurance law is very simple. The property has to be empty for over 60 to 90 days, more like 90 days. So if it doesn't have anybody living in it for more than 90 days, it's considered vacant. And so what we always ask our investor or your investor when they're ready, they just own a home, they're ready, is do you plan to have this property vacant more than 3 months? If they're saying the answer is yes, then they would need to get a vacant coverage, because the regular rental insurance will not, a landlord insurance will not cover any vacant. And so the coverage will reduce. And the two things are very important in a vacant property is theft and vandalism. Theft, they can come in there, steal your fridge, steal your, rip up the carpet, whatever is in your home, they steal it. No insurance company will pay a vacant property. So they're very strict on that. Vandalism is vandalism. They can graffiti, go in there, trash your home. Well, that's vandalism. When the vacant coverage does is that actually saying, all right, we're going to agree up to X amount of dollars coverage for this property while we're putting somebody into that property. So that will actually that will take the theft and vandalism out of the equation. So that's kind of where we said, all right, do I want to insure this property? If I pay 60 grand, do I want to insure it for 60 grand for that? Or do I want it to insure more to 100 grand and not the full replacement cost? That is where that vacant coverage can really play a factor. Vacant coverage can offer anywhere from 3 months, 6 months, 9 months, or 12 months, with most of our guys usually do it for 3 months. On the other hand, if you know for a fact that it's going to take about a month or two to rent someone and have an actual renters in there, your actual landlord insurance will allow up to 90 days for the property vacant to find somebody to actually to live there before it considered vacant. But after that 90 days vacant, they will deny any claim that involves vacancy. But they still cover your roof, all your structure is still covered with the exception of theft and vandalism.
Right, gotcha. Okay, that's a great explanation. And I thankfully, I think for most of our investors, and at least in our situation, 99% of situations, that's going to be a non-issue because, things are getting rented up very, very quickly. So
absolutely,
thankfully, we're not in a position where we really got to worry about that too much. But for any investors out there that have that issue, then it's just important information to know.
It also comes down to, if they have the property for a year or two and then they decide to add more stuff to the home after you folks already sold the home to them, then that's when they want to consider doing vacant. But I believe at the time when you guys turn the key over to them, usually within 90 days, from my experience, I've never had an issue here in Indianapolis to put somebody in a property in less than 90 days. 90 is more on the higher end where, you just have an oddball that in the winter and you're 40 miles out of the city. That's more of that issue where we run into 90 days vacant.
Yeah. Okay. I want to shift gears a little bit, and I kind of want to play devil's advocate a bit here. And I know Jack and I have talked about this before, and when we put together a sheet for an investor, everything is about cash flow, right? And we're obviously using, with some guidance from you, and thank you for that, we're putting a number on that sheet to, give the investor a very, very good idea of what the real cash flow is going to look like on that property, as it rents out, and what they should be considering for, vacancy rates and taxes and CapEx, future repairs, things like that. Given that insurance it's not a huge expense, but there's definitely some expense to it. I mean, we would know that, say, like on that same $60,000 example, we might have anywhere between, say, $650 and maybe $950 per year for coverage. I think that's a pretty big spread, but it's just to give people a ballpark depending on what kind of coverage they select. But, even if we take a number in the middle, if I self-insure, right, that's $800 a year that I'm not spending. So why could I not take that $800 and just put it aside? I mean, obviously it would go in my pocket as an investor, but could I put it in a separate fund and just self-insure? I mean, what's wrong with doing that?
Absolutely, and you do have a valid point. To what I tell people who want to self-insure, so two things: you have to have a lot of capital, because it's not just that $2,000-$3,000 issue that you're going to have, and I think we're going to talk about it here in a minute. But it's where you have the $10,000, $20,000, $30,000 issue when it's come to have the damage. So let's take $600 and divide it by 12. That's $50 a month that you're putting on the side as a savings, if you will, to protect your investment that you had put $50,000, $60,000, $70,000 into investment. Why not put $50 to protect every month, to protect yourself from having a catastrophic loss? I mean, it's just like if you buy a car, the same thing is, hey, I'm a good driver. Why do I need insurance? Well, number one, state requires you, it's a law. But let's just say the state doesn't have a law, right? You're a good driver, you do everything fine. I don't speed, I come to a complete stop. I don't do the California rolling stops or anything. I'm just a good driver. Well, yes, you are a good driver, but what if somebody hits you? It's not you that you're hitting somebody, but somebody hits you and he doesn't have insurance. Well, what happened? Well, in that same scenario, somebody can sue you, just happen to walk in a property and sue you $200,000-$300,000. You're going to have to dish that out. So I always say, is it worth it to take that risk of less than $50 on a $600 scenario, $50 a month to gamble $400,000 liability or a $60,000-$80,000 claim when you really have a big loss? That is something that I ask all my clients is, if that's what you want and you have the appetite for it and the budget for it, absolutely. Yes, you can save that $600-$700 a month or a year, or $4,000 in 5 years. And then year number 6 is when you have that claim. That $4,000 that you saved, now you're paying out $20,000 or $10,000. You just actually caused yourself to lose an extra $5,000 because you didn't go ahead and insure over for $50 a month.
Yeah. No, it's a good point. I pretty much could have predicted your answer, but yeah, I got it. Jack, did you have something you wanted to say?
I mean, I think you covered that pretty well. I mean, I self-insure quite a few of my properties. I do have the capital to back it up, and I guess I got that gambling spirit, but I definitely get your point, and that makes a lot of sense. So I think I really need to reevaluate, my strategy on how I'm going about protecting my properties. So good stuff.
The one thing what people look at insurance is, the insurance is to protect the loss. It's not something to gain financially. It's what happened if you have a loss tomorrow that you personally own and put your hard-earned money into. If you lost it, that's what its insurance is for, is by transferring that liability that you have into another company and let them gamble by you paying that premium. And then if that does happen, they'll have to pay that out. So they're on the hook for more than the amount that you're putting in. So, if you have an appetite, I said, absolutely go for it. But for the most part, a lot of us just like to, just be on the safe side. That's what the insurance is really for. Yeah.
So Man, here's another kind of question that we get, and it comes up sometimes, is I think just even homeowners in general are oftentimes confused about when they file a claim. Like what constitutes a claim, what constitutes not a claim. Like, for example, we're in the turnkey business, so we're creating opportunities and homes and duplexes that are rented, rehabbed, ready to go, right? So let's say a renter, trashes a property. I mean, we rarely see that happen because we've got such great management, but on the odd times that it does, and, you've incurred some, pretty significant costs involved in doing what we call a turn, getting ready for the next renter, could we then file a claim for something like that?
So a claim is very important, right? The insurance is there in event, I keep using this word, of catastrophic loss. It is there for, what is catastrophic loss? Well, it's a huge amount of the loss. I mean, that amount is really varies on each issue or to that person. Me personally, if it's over, $5,000, that's considered a catastrophic loss. Some people might think 10, some people might think $2,000, so that, again, it's just all how you want to determine. When to file a claim, I always say, look, if you can afford to pay it out of pocket, then do it. If you cannot afford to pay for out of your pocket to pay for that fix, then go ahead and file with your insurance company. Now, I caution your listeners is to file a lot of claims on your insurance company, because that will lead to non-renewal, because that goes on their record for 5 years. So when let's just say you have the insurance, for 2-3 years, and we see this all the time when guys just make claim for $1,500 or $800 for really a small amount, and then it affects the rate at renewal, but also it does affect the longevity of them with that carrier. So when you go out and you shop with another carrier, they will see all those claims that you file on there, and now they consider you of a higher risk. And so, people always say, well, why do I need insurance? Well, insurance is there to protect, again, for a catastrophic loss, not for, a $500, $600 claim issue or anything like that. I'll use a personal experience here. 4 years ago, we had a big hailstorm here in Indianapolis. And I have, at that time, I had about 4 properties within the hail area. One of that home had about a $11,000 damages to hail to my windows, my doors, my roof, and all of that. So the adjuster came out, looked at it. They knew hail was in the area. They said, well, here's your claim, here's your check for that. And at that time, I had actual cash value. So I actually did not get the full $11,000. They had to depreciate for how long I had the roof and the wind, yada, yada, yada. So the more of the story is, $11,000 now to repair those damages. Yeah, it was a lot of money. So I said, well, what about the other 3 properties? I need to go file claims for those 3. Well, my agent at that time said, wait, hold on now. Don't be doing that, because if you're going to file all 4 and have all those damages and have them come out and look at it, they'll pay for what it is, but you're risking of them not renewing your policy the following years. So she recommended me end up getting an actual, what do you call that? The guy that just come out and just evaluate the properties and look for all those damages and give you an estimate. And sure enough, those 3 properties came in less than $500 on all 3 for that hail. So I was lucky with those 3 homes. I filed the first claim on that home, paid for it, everything was fine, and then just end up paying $500 out of my pocket for the other 3 homes. Had I done that, they would have completely cut me off. I would have paid more the following year on all my properties, including the home that I was living in, because I'm a high risk in their world. I just happen to live in the area. They're considering me high risk because I was making way too much claim, even if it wasn't my fault.
Right. And you bring up a good point too, in that, oftentimes, even with or without the guidance from your agent, you start looking at costs of repair versus your deductible. And, there's always going to be a deductible depending on, again, what your tolerance is for that stuff. But I mean, obviously, if you got a $1,000 deductible and you got a $700 repair, it's kind of a no-brainer what to do there.
I wouldn't even call the claim. Or even, again, this is, everybody's all different, but even if it was a $1,200 to repair, my cost was $1,000, yeah, I can claim an insurance $200, but then that's going to look bad on my record when it's time to renew. Say you had a $200 claim, and that shouldn't have been there. So that would have been an ill-advised on my agents, had I went ahead and made that claim and she did not tell me, hey, that's going to affect on your claim. And that is something that we would personally tell you, do not make that claim. I mean, if you can afford to pay it, please do so, because that's going to affect you in the long run for the next 3 to 5 years.
So is it possible that the person that does not get renewed because of multiple claims gets, I mean, I don't want to use the word blackballed, but obviously there's stuff that goes into the computer. Are the implications such that they could either A, be denied, or B, charged higher premiums subsequently? Is that kind of how it works?
Yes and yes. Yes. So they would. So let's just say you are a State Farm client now, and I just love using State Farm name. I love those companies, nothing bad about them, but it happens more than often that if they make over one claim, they would not renew you for another 3 to 5 years. So now they consider you in the insurance, you're a preferred risk, or you're a standard or a non-standard. Now, if you made more than one claim, you're considered a non-standard type of clientele, even if you have a perfect credit, perfect driving record. I mean, been with the company for 25 years, they're still going to consider you a non-standard because of the claim history that you've had with them. And it travel with you nationwide. So it also will affect on your personal homeowner insurance at the time of your renewal, because they will do a check every year if you're with the same company.
Gotcha. Okay. So you started at the very, very beginning. I want to kind of dial back around to the beginning of the conversation. And when you introduced yourself, you talked a little bit about this differentiation between, the broker and the agent, and so obviously as Americans, and most of the listeners to this show are Americans, we're all subject to lots of different advertising, and we see, you're in good hands and like a good neighbor and all that other kind of stuff. And we get sort of almost programmed to sort of trust that agent down the block, that guy or gal who's hung his shingle with that company per se. And you are not that guy, right? Like you're a broker. And I want you to explain the difference between that and the guy or gal that just hung that shingle down on the corner.
So the difference between that, we would use either word broker, independent broker, or a captive. A captive agent would be somebody like State Farm, Allstate, where they only represent one company. Most independent guys, or I should say all of them, are really a broker because we represent multiple carriers. In my situation, I have over 30 different carriers that I can shop. The advantage of working with a broker like myself is, number one, is I don't charge you for any of that service, and the premiums are already predetermined by the insurance carrier and the state. I mean, they file with the state every year what they will charge per square foot per year and all that matrix. So the great thing about working with a broker like myself is I can shop, find what you're looking for, the coverage that you need at the price you want. So if State Farm comes back at you, or Allstate say, well, here's the premium, this is the premium, they really don't have anywhere to go. With me, I would be able to shop and I would find you obviously the best price. And I will come back, if for the coverage that you're looking for, I will come back with the exact price or the best price of all the 30 carriers that I found. And from a lot of clients, they can appreciate that because we can shop for them with all these carriers without them calling each agent or agencies from one to another. And that can be time consuming. I mean, most of the time they'll be on the phone for 30, 45 minutes. That won't happen with us, by the way. But with, and then it takes them a day or two to get back with a quote. And any kind of modification, a lot of time these agents don't take the sense of urgency to get back with their clients to update them, what the premium is. With us, we pride on having a quick turnaround and very accurate, but also making sure that, hey, this is the right coverage for you. We don't just want to sell you something that you don't need or don't want. That's the one thing that we pride in, is say we need to make sure that, is this what you want? And here's the actual premium that the carrier is charging you. So again, I just can't reiterate that working with a broker, you have more options for what you're looking for. Here's the other part, guys, is, if they do business with us, every year we always manage their policy, make sure that if anything changes, and if you have a huge rate increase from that carrier for whatever reason, we will shop on their behalf without their knowledge to make sure that, they're getting the best price. So when they get that renew notice, they have a big increase, we're already proactively shopping for them. And we're going to make that phone call, say, hey, we noticed that your rate went up. We did shop with another company on your behalf, and here's what we came back with. Instead of winning up $100, let's just say hypothetically, it only went up $40. So we're proactively watching their policy every year, because we're not the type of guy or agency that sells you one policy and you'll never hear from us or talk to us again. We have 130 licensed customer service actively monitoring your policy year in, year out. And if there's any changes that needs to be, that's unwarranted for, we are going to be proactively making sure that they're getting the best deal for their property.
That's really awesome. Jack, I know that you are a big appreciator of these kinds of efficiencies. It's so great to have a situation where we can, let our investors loose on somebody who, in essence, is one-stop shopping and can really comb the marketplace out there for that sort of stuff.
It goes back to everything that we talk about, which is creating passive streams of income. And the less time and energy and headache you have to put into it, because of systems in place like this, the more passive in nature it is. So I love all things passive income, and I love things that are really truly passive more so than others. So yeah, this is great.
Yeah, that's awesome. Well, do you have any final questions, Jack? Because I've got a lot of clarity about this stuff now, and I'm sure that our listeners have too. Is there anything, Jack, that you feel that we missed?
I think we nailed it. And I think it's probably, we've hit the point, the tipping point of which, our listeners are going to start checking out. I'm kidding. This is actually very engaging, and much more so than I thought. When you first doing a podcast on insurance, it's like you said, Check, at the beginning, and it's probably not the most exciting subject, but very, very, very important subject. And we get this question all the time. Every single new investor that comes to us are always asking insurance-related questions along these lines. So now we have a great resource to refer them to, so that they can hear directly from the expert himself. So I'm good, Checky. And what I would want to ask Man is, how do people reach out to you? How do they get a hold of you? What's the easiest way for this process to go if they have additional questions, or if they want to get more information on how to get insurance through you, Man? How do
Absolutely. They do that? We're open. I say we open 7 days a week. I'm kind of like you guys. Always looking for working to make sure we'll keep the business going. I can be reached in my office. It's 317-863-9216. That you guys can visit my website. It's www.brightwayphung.com, and it's spelled Brightway as in BRIGHTWAY, Phung, PHUNG.com. And it has my website on there. It has everything you need to know about our agency, and they can even go online and just give us a basic information, their name and the address that they're looking to insure. And it's the moment they submit it on there, all that information comes to us. We get to work, and most of that information are all accurate, and we can actually find, within a couple hours, we'll call back with the preliminary number for them already. And so we're very quick when it comes down to a quote. You guys, your clients will never have to wait more than a day, which is, a lot of time to get an actual quote that's pretty accurate.
Excellent. All right. Well, if you got value out of this podcast, everyone listening, please share it And make sure to leave us a 5-star review. That really helps us rank with the other against the other podcasts out there, so that this content can get distributed out to more listeners, and we can really help educate people on how to become successful real estate investors. And there's a lot of different aspects to it, and we're trying to cover each part of the whole buy and hold game, so that you come out after listening to these podcasts and you feel like an expert in a guru yourself. So we'll put all that information, Mon, that you just gave on the show notes. And we would like to invite all of our listeners to take a look at our brand new website. It's still the same URL, highreturnrealestate.com, but we got a very nice, brand image, changeover. We got a lot of updates. It's really, really nice. The guys that put it together for us have been working on it for a few months, and wow, it's we're very, very proud of the product that's there. So if you are looking for some great return on investment for passive turnkey rental properties, please go to our website. We'll post all of our available deals there, or go to the website and book a call with us, and you could possibly get insider information as far as deals that we haven't even placed on the website as of yet. So again, that's highreturnrealestate.com. So thank you, everybody, for listening. Shecky, thanks for setting this up with Mon. I really appreciate the content, and we'll see you guys next time. Yeah, it's been great. Thank you, guys. And thank you, Mon, so much for, just your professionalism and your expertise and your friendship. It's really, it's great. And we really, really appreciate the value that you brought to this show today. So thanks, everybody, for listening. And thank you, Jack, as always. And we will see you next time. Thanks for having me, guys.